Good morning, everyone. How's everybody this morning? Hey, Ben. How are you? Well, here we go again. How's everyone doing? Let's go take a quick look at where we are in the zoo. Hey, Raj. Shanghai, how are you? Long time. Okay. Yesterday, overnight inventory was what? Almost 100% long? This time, overnight inventory is almost 100% short. So we're going to get to know these terms really well because all the crazy stuff that happens in market profile is going to happen over the next, oh gosh, who knows how long. How we work this is there's the close of yesterday, and almost 100% of the time and volume has been under yesterday's close. So when we say that, we say that when overnight inventory is under the close, it is short. When overnight inventory is above the close, it is long. So right now we have short inventory. Okay, that's great. That's great, JJ. Now, what the hell does that mean? Okay, and how am I going to make money off of this? Well, a couple of interesting things happened, right? Yesterday, what was yesterday? You guys ever heard the term in equity trading called a gap and trap? Anyone? Bueller? No? No one's ever heard of a gap and trap? Okay. Okay, a gap and trap is a technique used by wholesalers to lighten the load of their inventory. So what you do is, after a market sells off, right? It's going to sell off a little. Like we've had our selling, okay? Then what happens is the dealers have to absorb inventory. So the dealers, they're like, they're long. They take in product because they have to. They have to provide liquidity, okay? But every once in a while, the selling, right, the supply coming in from overhead, it slows down. So, when you get a cycle, you get that kind of selling, and then the selling kind of slows down, right? And then the markets will get a little bit short, too short. A lot of people will start getting short in the hole here, underneath 5,000. And this didn't happen on purpose, but it happens because of the human nature of how people think. So when people get short underneath a very big round number like 5,000, 6,000, etc., right? Opportunistic buyers will come in and start buying. And that's exactly what they did yesterday. They came in and started buying, and so the dealers just started shutting off supply. You see a very thin profile, right? A very thin profile yesterday. But the problem is the dealers have inventory. So we took out yet the previous day's high of 2 days ago, which created a lot more buying from people who were trying to cover short. And so then what they did was they just took this inventory, right? and they just hammered it. Okay? You'll notice that yesterday's low did not take out the previous day low. The overnight low so far has still not taken out the low of 2 days ago. But what's going on is, and this is where market profile is cool, you can see that there's the short covering of the people who got trapped here. You guys see that? Now, this doesn't make you money right away, but what it does is it gives you market awareness. So if you're aware of the type of business that is taking place, you can trade intelligently as a smart business person instead of like just chasing trades and using all these things like FOMO. Here you get a little bit of knowledge, right, that you can actually use to make good business decisions. Okay? So the people who got caught short here, look at the time spent. Very little time, right? Now we're spending time underneath 5,000. And what that's doing is there's doing two things. We're getting rid of the people who own it up here. They're flushing into it. And it's being bought by people who got short yesterday, right? Remember, equities settle T plus 1, not T plus 2 or T plus 3, which means today they've got to take care of old business before the end of the day, right? So if you were short under 5,000, right? And I'm not talking retail traders. I'm talking big funds, people who, people who swing a big line, as they used to say in the 1912, right? People who trade 5,000, 10,000 contracts, right? Those partnerships, those smaller funds, right? So what happens is this allows you to see instantly what's going on. So now should you be shorting down here? And we're going to go take a look at the close-up profile to see how quickly the market rebounded, right? When the market rebounds very quickly, there was a bid, I was watching it this morning, right? And when it came down and it came close to the low of 2 days ago, man, the shorts came just running into cover. And it just jammed, and you'll see it had this huge move higher, right? Look at that low, 48.72, right? We got down close to 48.67, and they just came barreling in. And I know because I used to do a lot of short squeezes. It's my specialty. Takes one to know one. This is done not on purpose, but it's done because people get trapped. And look at it. There's that. It just jammed. And look at the J low, 49.14 compared to the low of the day or the overnight. And then they just ripped it back into the previous day range, which had people's stops there who were short. And so it took their stops and another pump and dump. Okay? No. When supply shuts off, it means the sell orders are done, Luke. Things are very, very simple. All right? When supply shuts off, it means I got 100 oranges, you got 100 oranges, Dan's got 100 oranges. We're selling them at 50 cents, but then we see 5 busloads of buyers come pull up in the parking lot, so we raise the price. Make sense? It's real simple, right? Don't worry about outside capital and buy themselves, and that's not how market making works, okay? But you don't have to know about that. What you got to know about is when do you get long, when do you get short, and how do you manage your risk? That's the most important thing that we try and convey in this room at Microefutures. Because we are here to try and take all the BS that people talk about out of trading so you guys can make good decisions. Does that make sense? Right? What knowledge can you use in a practical way? Right? I'm not trying to be sarcastic or facetious. Right? But I don't want you guys wasting time wondering what market makers are doing and what Ken Griffin had for breakfast and which next dinosaur bones he's going to buy, because that means nothing for your wallet. I want to try and get you information that you can use. Could there still be more sudden movements? You bet your sweet patootie, DJ Trader. This market, nothing is resolved, right? They're charging us $2,000 to trade one micro and $20,000 to trade a mini. It's full pull margin, right? You want to take the ride, you got to pay full price today. That means the brokerage firms are protecting their capital, right? Risk management is the agenda of the day. So where retail traders look at these big movements and go, ooh, lots of opportunity, brokerage firms go, okay, let's pull in the sails, let's batten down the hatches, right? So you gotta be careful, all right? And I know I sound like the old man telling you to be careful, but I've seen people lose everything. So I don't want that for you. I want you to have good information. If you are going to trade, I want you to be able to trade intelligently and not lose all your dough. Okay? So that's what happened. So we have an understanding of the business that happened before we started this session. Now we know two things we know, right? One thing we know is that the smart money shorts covered here. The smart money shorts are covering. But we also might have some people getting short in the hole. Why? Because we went from 48.70 all the way to 49.70, 100 points. Zip! That's a 1-minute chart, ladies and gentlemen. Okay? So, you know, they need to teach this stuff in school so people can make better decisions with their money. I really don't know where Pythagorean theorem really helped me in life. If they told us how markets were made, that might have been a bit more helpful. you know? Right? I've got pi memorized to what, 12 digits? 3.141592765 or something like that? Why do I know that? It has never helped me in life. Oh man. Okay. There I've said my soapbox for the morning. Right? So, here's our cost basis. 48.98 half to 49.16, right? You remodel bathrooms and write algorithms. Well, you're a true renaissance man, Mike. Now, if you can make a flan, you know, it's up to you to put the F in fun employment. So there's your cost basis. How do I get these balance zones? Right? What I do, and it's not rocket science once again, right? What we do is we take a high and a low. And when we look below that low, do we go to that high? Now that's not exactly very clear, but it worked here. A low and a high, high. You look above that high and you go right back to that low. See, right there? Right? So that is cost basis. If you draw a volume for a profile, you'll see a big chunk, right? So what do we do now? We just take this and we double it to the upside. So there's 2 times profit. And then I use purple for another color. So you'll stack 4 of these on top of each other. That's 4 times profit. Very simple. Well, you've noticed correctly, DJ Trader, right? The cost basis is increasing because the ranges are increasing and the rotations, right? Very good observation there, DJ Trader. The rotations, that up, down, the size of those is getting bigger, right? Before all this nonsense, the size of the rotations were like this. They've gone from that to that. That means this is a really good thing. Very good for bringing that up, DJ Trader. What does it mean for us as retail traders is that we have to try and operate at the edges of the rotations only if we're going to trade, because margin is 100%. It's full pull margin, right? So if you're going to put up $20,000 to trade one contract, you better make it a good trade. You know what I mean? So we're going from that to that. So you want to trade only at the edges. That's where you have the better, better chances of success if it's rotation, because it's either going to look below and fail or look above and fail and then rotate back down to the middle and then to the other edge. Now, the other thing that we have to do, right, which is, it's difficult, it's not easy, right, is to admit we're wrong quick. The faster we admit we're wrong, the cheaper our mistakes are going to be, right? Just makes sense, right? At my old brokerage firm, there was a guy. He was an okay guy, but he was a bit of a doofus, right? And his father had a lot of money. And he was on he used to trade for he was the assistant for one of the traders, was one of the smartest, sharpest guys on the street. And they were doing a trade, and he screwed up the foreign exchange on the trade. So instead of fixing the error right away, I think it started out as a $30,000 error. This knucklehead hid the ticket. Back in the old days, you didn't put the tickets in computer. You used to write them up. So he hid it. And he got away with it until they did the books at the end of the quarter and went, hey, we're off. By the time they did the books, that $30,000 error had snowballed into about 150 grand. But I don't know how he got past it. He stuffed it into a client account, right? And used it. Anyway, they're very creative accounting back in the days in Canada. Anyway, at the end of the whole thing, it ended up being 500 grand. So instead of just cutting the loss and admitting that he had screwed up and take the $30,000 hit, he let it snowball over almost a year until year end to 500 grand. Right? They don't throw people in jail for that, Mike. Well, except Nick Leeson, but he took down an entire brokerage firm. Right? Anyway, just saying, right? Just saying. So, he was fired. And then he had the stones to fight them in court and say, I'm not paying it. He was a character. It was a character. So, second step, we draw out these ranges, which are bigger, the balance and the double. So, what are we doing now? We've taken this product, right? We're going to take this and distribute it up here, right? When we run out of buyers, like we did here, we put it on sale. And you notice, check this out, the market came right back to this little cluster of candles. See, we took it, that was the first store that we stopped to sell at. That's distribution. And then we got some real buyers in, and then we put it right back on sale to that little cost basis, stopped selling, lifted it, and now we're going to chop around in this area here until London opens in 10 minutes. Okay? That is how markets, the mechanics, right? The mechanics of markets. Ah, responsive and initiative buying. Initiative buying is when I come in and say, like we work at a fund, and you're my analyst, and you go, JJ, hey, um, on Apple, right? Um, at this certain price, load the boat. Okay? So when Apple goes to that price, say it's $200, right? I will step in and I'll start building out a position. And I am initiating a position. And where that comes from is in the old days when you used to give futures trades verbally over the phone, you would say to open by one E-mini contract 49.41 and 3/4 to open, which means you're opening the position. When you sold the contract, you would say to close, right? So that is initiating a buy, right? When you short, you say you sell to short, and then when you buy it back, you say I'm buying 49.40 to close. So, oh, look at that. Did you see that? What did you see that? I wish I could rewind it just now. When we came down here, you'll see the market, it looked like it sat on a tack and just jumped. That's responsive buying, right? Responsive buying, the way I think about it, is I'm short at 43. It comes down to 41. I run in there quickly to buy it back. Everybody else does too because it's the previous day low, and boom, you get that little pop. So I would say responsive buying is buying by people who are trying to cover a short. But initiative buying is when large players come in and start building positions. And it looks very different on a market profile. The profile will look, if it's a whole day, it'll like that B profile, and then you'll see those B profiles stack, right? The profile will be tight because large traders, when they're building a position, they're not going to build a position in a 200-point range. It's very hard to do that because if you're trying to buy 5 million shares of Microsoft, right now they have ways to do it with dark pools and places to cross blocks. But if you're just trying to buy a position in a company, right, you got to keep it quiet, right? So it's like you're building a position versus you're covering a short. Think about it that way, right? Remember, there's a scene from Wall Street, 1986, so 1987, which is very current. We're in chop right now, so I'm trying to distract you guys, right? Where Michael Douglas is doing some insider trading, and he's buying a company called Anacott Steel, right? So he calls his trader and he goes, start buying Anacott across the board. He gives a limit, right? Use the offshore accounts and keep it quiet. You want to build your position without everybody knowing that you're building a position, because if they know that you're buying 5 million shares, they're going to front run you, right? That's the business. So I would be the guy on the other end of that phone who was trading that particular deal guy's offshore account. Make sense? And I would have to buy quietly, right? We buy quietly and we sell quietly. That's why when you hear people say, "Oh yeah, big orders on the DOM," no large trader is going to show his hand. You guys get it? I don't know that, Mike, because I never worked at Night Trimark. I was always just the idiot giving the order on the phone. Because I would just when the larger traders were busy, I would put in the futures orders, and we only had one really rich client who traded futures, um, and he wasn't my client, so I didn't know anything about futures at that time. And that's when they were creating the E-mini. It was right in that 96, 97. Now let's see if we can stay above 49.51. Where is VWAP this morning? Oh, I haven't even set VWAP. Boy. Okay, I better do that. Anybody got VWAP off the top of their head? Oh, I think Mike, that open close field is that's like back in time. I haven't seen anybody ever say that lately. Never, not even since I've been trading retail. It's like an old thing. It's at 40? Oh, okay. Thank you. So if VWAP's at 49.40, we are in, as the penguin would say, distribution. Right. Whoa, hello. Somebody's got, look at that. Somebody wanted out. Did you see how quickly, it got hit? Okay, so now we know where the seller is, right, folks? They showed themselves, right? They're there and they're aggressive. Okay? So in your trading journal, right, what you want to do is say aggressive seller at 49.57. Right? Because most likely when you get up to that area again, he or she is going to step out and whack you across the head with a baseball bat. Let's see if we can hold VWAP. Yeah, sure, Mike. No problem. I just saw your message. Sorry. Oh. Yeah, this what we're looking for also is isn't it interesting that that 41 is right where the previous day low is? So if we start to catch bids at VWAP and 41, that means people are short underneath yesterday's low. Now that is buying from short sellers, so you can't build a house on it. But if we stay above 49.41 going into the London Open, you're going to get another short squeeze like we did yesterday. How long it lasts, I cannot tell. Okay? But if we can't get underneath the previous day low, then the shorts are going to be in some trouble because look at that. The overnight POC is at 32, so that's where the concentration of cost basis is. I'm sure there are people short there, and I know for sure there are people short under 24 and under that J low, right? So, right, that's a J low trade when J opens and can't get lower. Oh boy, you get that rip. So we've got some people short again because tonight's overnight low did not take out the low of the week, right? That low of 2 days ago. Right now, here's the question: can we get right? And inventory is short, so the markets are acting as normal. When inventory is short, you look for that move higher, right? Can we get back above the close? Let's see. That's the question of the evening, right? Can we get back above the close of yesterday? Here's London. Let's see if London can hold that 51. Now, you know, if you're long, right? If you're long, look, the sellers, they move down to here. See? They were aggressive here, and they just moved right back down. Now, if we can't get back over 51, look for VWAP. This is how you manage your expectations when you're trading. Okay? And it's not easy to see at first, right? Because none of this is I took a 52. I'm just trading a couple of micros and I'm flat. Um, it it's not obvious, right? The sellers are going to be very persistent, Jonathan. Very good observation. The next set of stops is up here at 69. This move down, whenever a market does this, when inventory is short, right? Unless you've got a lot of selling, when it dips, right? And it'll catch people short under VWAP and it caused that rip. Couldn't get to VWAP, boom, right? Once you have achieved sufficient replace volume with sales, you right? Once you achieved sufficient sales, more buyers will come in. You only pull it down again when you have to put it on sale, DJ Trader. Right? You got to put it on sale to bring buyers in. Just like a store. It's just commerce. Right? Nice work, Jerry. Nice work. See? Look at that. Oh my God, look at the order book. The order book on the white micro just went Casper the Friendly Ghost. Be very careful. Okay? And what does that mean? In English, that means nobody is playing. Anybody, where are all my Dom watchers? Where are all the dominatrix guys and gals? Have you looked at the size? Leaping lizards. What a poop show. Exactly, Howard. Exactly. Yeah. That, my friends, is a short squeeze. Look at the size of that spread. Welcome to the Terror Dome. Now it's starting to fill in a little bit. Doesn't mean go back in the water. Oh, Howard said it was a quick 20-point drop. 100 points 1 minute, right? Oh boy. Well, this is how they built the market. This is what you get. This is what you get when you can make a market execute in milliseconds. Right? That is I did tell you that they were going to squeeze it. Now, did you see that candle? The size of that squeeze, my friends. Let's see if we can stay above it, Mohammed. Great observation. God, I couldn't dream up a better teaching scenario than this. Oh, thank you, goddess of order flow. That candle occurred because what I was talking about with the order book, right? All of a sudden the orders just disappeared, right? There was an order here for 6 and then nothing for like 6 points and then another order for 4 contracts. There is nothing in the book. So people who were trying to trade that, who were shorting that, they got destroyed. This is the pump. Now this is the dump. So now we're going to take the cheap crap that we've got here, right? We're going to take this cheap crap and now we're going to sell it back down to where we bought it. Cost basis. Yeah, what I don't know what the thing is, microseconds, and then there's what, nanoseconds, and I don't know. But I'm just saying. Now, do you understand why you need to admit you're wrong quickly? Because even if you had a stop, it might not have gotten honored until 8 points higher. Just because you want to buy, if there's no sell order at the place you want to buy, guess what? You're not getting filled. Right? Thanks, Mike. Micro, nano, pico. I love having math guys around. I don't have to Google everything. Does it matter? No, it doesn't. But here's the thing. In this market, you're going to have a mixture of both, Dan. You're going to have new sellers. You're going to have profit takers. It's going to be like one big goulash of order flow. And it's going to change so quickly that it's not really going to matter. Right? This is called a fade. Right? We're just going to fade it back down. Right? So if you own inventory, right, underneath 49.51, you're just like, oh yeah, oh yeah, 5,000, yeah, sold, sold, sold. You want to show me it? Sold. Yeah, sold. Whatever you want, sold, sold, right? Beautiful. Exactly, exactly, DJ Trader. I think we have some physicists in the room. We have a lot of microbiologists and like cell biology guys. So we're just bouncing around the 49, oh, 49.88s. Right? This is a little bit of a short cover coming in here at 49.86. Now let's see where they sell into it. Come on. Come to Papa. Come on, come on. Yes, yes, of course. Don't worry. We'll sell it to you at 92. But yeah, 5,000, don't worry, it'll get there. Yeah, just go ahead, buy, 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 buy. Right? So we're just raising the offer to try and bring those suckers in, and we're going to nail them somewhere here. Where do they sell in? There. First seller is there. Second seller will be at the top of that candle. Ugh. Right? So just because you have your stop at a certain level does not mean that it will be executed. If you have a buy stop and there's no one to sell, you're going to get filled at the next available price. That is what we call a thin order book. And that allows large traders, this is like, you know, it's like shooting fish in a barrel. Right? You just bring in uneducated people with money just falling out of their pockets, and you put them into like an alley in the hood and they're just getting rolled. So we don't want that for you, right? You guys, we got to be street smart, okay? In times like this, it's street smarts that'll get you going. So the street smarts are now we went down to the middle of this next zone. We caught some buying, right? We found some bids, right? Let's see, but we got a seller right here and we got a seller right here. So if they keep coming, we can keep selling, but can you trade this? I don't want to trade this. Not with a book that thin and not with the price jumping around, right? Here's a thing. When markets are slow and rotating, sellers are in control, yes. Most of the time, people don't realize this, but the whole market is controlled by the sellers because the sellers create are they're the store where the product is sold. So they set price according to the people who are coming in, the customers, order flow. Price is set by the order flow and inventory that's there, just like any other market, right? So sellers are always in control, especially when prices are going higher. Here, the sellers were in control. Buyers are not in control. What buyer wants to pay more? That's why when people say, oh yeah, buyers are in control, the market's going up, right? Right? Oh, look, we got people. Look, like we got some fresh meat. Look, fresh meat coming in, right? Look for 21, right? Fresh meat on deck. A thin book means the order book is thin. There are few orders on each side at every price level. So where you have 50, 100 contracts at every tick, here you have 3, and sometimes none, right? Yeah, it's an interesting London Open. You've got to be quick. Exactly, Moran. You got to be like quick draw McGraw, right? That's why you're getting this. But look how orderly it looks on the chart. It's actually quite beautiful. Look at that. They took it, they slammed it, they stopped selling here. The shorts who got short here came in to buy. Bid, 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 bid. Let's raise price, and we got some fresh meat, right? The sellers are always control. The market is created for sellers, right? They bring product to the market to sell to you, right? Now be careful pre-shorting 21. I would like a look below and fail, or at least a couple of candles to close under 21. Remember the order book is thin. No, buyers are not in control when prices are going higher. Dan, look, Dan, I'm selling a Rolls Royce. Do you want to pay 100 grand for it, or do you want to pay 300 grand for it? It's when people overcomplicate the simplest things, right? So, yeah. So buyers are not in control when prices are going up. It's the people who are selling. And this is the problem because not against you, Dan, against the way they educate us, right? They teach us to be the buyer. The buyer is not the one who makes money. The seller is the one who makes money. That's what a market is for. A market is where you bring 150 million shares of a stock and sell it. That's why they call it exiting into the retail flow for profit. You could get paid to buy stuff. It's the lack of sellers. No, it's when the sellers identify that there are buyers. And the more aggressive the buyers, the more aggressively the sellers will raise price. Think about it like you guys are the sellers. Watch 21 now. All right, here we go. Look above and fail or look above and go. I will let the large traders figure this one out. Ooh, see? That's why you don't want to pre-short, right? That's why you don't want to pre-short. So now we found the bid going into London and it's at 49.86. I'm telling you folks, right? And I don't mean to sound egotistical about it. It's just the job I did. I have dumped billions of shares of stock into US markets. Okay? Billions of shares of stock over a 25-year period. Okay? You set the price. You create the chart. Now, futures is a speculative market. It's not like someone's creating it to sell it, but the rules of inventory still apply. Exactly, Jonathan. They lower the offer to attract buyers, right? Hey, attention Walmart shoppers, right? For the next 20 minutes on aisle 17, we've got, Jimmy Dean sausages on sale, 2 for 1, but only for 20 minutes. Everybody rushes to aisle 17. Then they raise the price. I miss doing deals. I miss working with my crew. I had a couple of crews that I worked with. I was the executing trader for. I miss it. It was fun. Never laughed so much and made money. So much money. It was stressful at times. I've worked with some bad crews, and I've worked with some crews that operate like a finely made Swiss watch. Beautiful. I remember one crew of old guys. They did a deal in the 80s, and they resurrected it in the 90s into 2000. And in the 80s, they took the stock to $100, split it, took it to $100 again, split it, took it to $100 again. This guy was a god. He's a trader at McDermott St. Lawrence. Made that company so much money. It's a friend of mine's dad. And these guys, and then they revived it. About 15 years later, changed the name. Still computer software. I remember meeting these guys. They didn't use cell phones, no electronic communication. They met once a month. Everybody knew what they had to do. And it just went like clockwork. Made hundreds of millions of dollars. They were a hell of a crew. Seller at 21. Seller at 50.21. Let's see where they take it. See, can you guys see? Sorry, I'll make these candles a little bigger. Sorry, I have a little too much nostalgia this morning. See how this seller's come in right there? Now, in 22 seconds, the next candle is going to open, and let's see if it stays under 21. I'm not going to trade it because, frankly, it's a little too choppy for me, and I haven't had that much coffee, and I've been waxing poetic about the old days, so I know my execution is going to suck. So let's see if we can take out that 24 seller. If that 24 seller moves up, it means they've seen buyers. Yeah, I love the history of the market. The best book ever written on the stock market is one you've never heard of. It was written in 1873. It's called Inside Life on Wall Street. If you Google it, it's on Google Books for free. William Worthington Fowler. It is one of the most amazing books ever written. It tells you how everything is done. And you know what? It hasn't changed. It's gotten more efficient. Guys like Mike have come around, built algos. See now, had I been a bit more dialed in, I would have been trying to short 20. But it's always easier to say it after the fact. At the time, I looked at the DOM and I went, "Oh man, it's thin, and it's a lot of money to trade this. If I screw up, right? Not the greatest discipline, right? Had I been more disciplined this morning, I would have been on that 20 short, right? And you put your stop here, right? Because you know your risk, right? Your backup is here, right? So if you're shorting here, that's your backup. Because if your backup, if this guy goes away, right? If this group of sellers, if they lift, there's no reason to be short. So you'd short under 20. Of course, you're not going to hit 21. Wherever you short, that's your danger zone. There's your out. You got to use bigger stops because these candles are massive. And then you'd put some bids before 5,003, so you'd cover as it hit. As the market drops from 16, it's going to hit that. Now, let's see if it stops here at 96. Right? I'm just curious. Does it stop here? Remember, because that's where the seller was before? And if it does, look for the bottom of these candles. Yeah, I've heard good stuff about this GAN thing, but I've never actually read the book. And it's funny because I remember we were talking to somebody and they were like, do you know GAN? Do you know GAN? Do you know GAN? I'm like, no, I've never met him. Books. I didn't know it was a book from 1923. Yeah, no, I've never met the guy. Yeah, he's kind of been dead for a while. So, see, we came to that little position here. That was funny. Because she kept asking me, like, she made it sound like it was a dude. I was like, do you know GAN? Do you know GAN? I'm like, no, I've never met him. I miss operating. This is the perfect time to do a penny stock deal. Okay, where's our seller? When markets fall apart, everybody rushes to penny stocks because they try and make back their money. And yeah, I'm looking to see where the supply shuts off. And what I'm looking for now, Mohammed, is I'm looking for a rotation. Right? I know that there's a seller here. Where does the selling shut off there? Let's see if we rotate back and forth in this box. So is there tariff stuff coming out today? Or was that last night? Yeah, I would like to. I wish I had the time to read all the books I want to read. Who's the other guy? Wyckoff, right? Okay, so they've gone into effect. So he's not going to pull a rabbit out of his hat today, is he? I feel like I'm watching Bullwinkle and Rocky. Hey, Rocky, watch me pull a rabbit out of my hat. Nothing up my sleeve. Oh, China is going to retaliate? So this is like, that would be a first. That would be like, yeah. So it's like when two families go to war, like The Godfather. Great. These guys are retaliating tonight. Yeah, maybe it's time to hug it out. We'd like to, I really don't feel like paying 20 grand to trade one E-mini contract. I think it's time to hug it out. This is crazy. Madness. And I've been warning for years. Me and all the older traders, like Paul Asmar, who's a legend, you know, we've been going, you guys haven't built out a trading range. It's been up, 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 big sell off, up, 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 up. I go, when this thing comes apart, it's going to come apart like a cheap suit. And boy, did it ever. Let's go take a look at the weekly while what I'm doing is I'm still looking for that. I'm looking for that two-sided trade here. The guy's a legend. I'm the one who found him on Twitter. I'm like, hey, you got to do this. I mean, the guy was on the floor at SLKC for what, 40 years? 30 years? 40 years, I think. Great guy, too. Okay, we got that seller. Seller's parked right there. I know so much about the seller because that's my job. I used to be the seller, right? So if you look at the bid and offer, I was always the offer. I was never the bid. I was always the seller. He's been on it in the early days. Yeah, it's funny. Like when I see people, and they say the old name of the firm, I always reach out to them that they worked at. Now let's see if we can stay above the close. We got a couple of minutes left. Does anybody have any questions? The delay wasn't so bad this morning. It was good. Market making lawmaker is providing liquidity. Okay? So you you are designated by the exchange to provide liquidity in a particular instrument. What does that mean? That means, lawmaker, if you wanted to go buy 10,000 shares of a stock at $5, the market maker is going to try and sell you all 10,000 shares of that stock at $5. If the market maker didn't exist, you'd buy 100 shares at 5, 200 at 550, 300 at 570, and the price you would drive the market up with your buy order. So by the time you're done, you might spend $7 to get 10,000 shares, right? The market maker allows you to get what you need at the price you want. If they don't own it, they will short it to you and take risk by doing so. Oh, sorry, Kevin, Asmar. So that's what their job is. How they make money is pumping order flow through the spread. They buy on the bid, they sell on the offer. If you can pump 1,000,000 shares through a 3-cent spread, do the math. The more volume you pump through a bid and ask, right? The more business you get, The more order flow you get, the more money you make. Oh yeah, FOMC minutes today. What, 2 p.m.? Maybe I'll take a nap. Remember that episode of Seinfeld where his dad's like, "Yeah, I'm going to do this and this, but first I'm going to take a nap." All right, folks. You got to have a sense of humor in these days, right? Otherwise, you're going to drive yourself nuts. Thanks, everyone, for joining us. Come see us at Microefutures, and we'll promise we'll teach you things that you can actually use to make money, right? And have a laugh along the way. Be safe out there, okay? And we will see you all at 9 a.m. Eastern Time for the regular trading hours session. Thanks, everyone. Bye for now.